The dollar is strong, stronger than it's been in decades. And that's supposed to be good news. But here's the uncomfortable truth most people don't want to say out loud. The stronger the US dollar gets, more fragile America's position becomes. Not weak today, not collapsing tomorrow, but quietly, structurally exposed. And the danger isn't obvious until you zoom out. Right now matters because the world is tightening. Interest rates are high, capital is nervous, money is moving fast, and it's moving toward the dollar. Investors call it safety, policymakers call it confidence, headlines call it American strength. But strength can turn into a liability when the system depends on everyone else staying weaker. To understand why, we have to start with how the dollar actually works, not how it's advertised. Most people think the US dollar is just America's currency. It's the world's operating system. Global trade is priced in dollars. Global debt is written in dollars. Oil, food, shipping, aircraft, semiconductors, all dollar denominated. If you're a government in Brazil, Turkey, Egypt, or Indonesia, you don't just use dollars, you owe dollars. And here's the first quiet problem. When the dollar rises, everything priced in dollars becomes more expensive for everyone else instantly. Not next year, not gradually, immediately. That includes debt payments. Imagine borrowing money in someone else's currency. Now imagine that currency suddenly rising 20%. You didn't borrow more, you didn't spend more, but you owe more. That's what a strong dollar does to the rest of the world. For decades, the system survived because dollars were cheap. Rates were low. Liquidity was everywhere. The US exported dollars, and the world absorbed them. But now the direction has flipped. The Federal Reserve raises rates to fight inflation at home, capital floods into US assets, the dollar strengthens, and the rest of the world starts bleeding, slowly at first, then all at once. This is where the irony begins. A strong dollar looks like a vote of confidence in America. But it's also a global stress test, one the US doesn't fully control, because when foreign economies weaken under dollar pressure, they don't just suffer quietly, they react. They sell US assets to raise dollars, they dump reserves, they tighten their own economies, they slow trade, and that feeds back into the US through lower exports, weaker global demand, and financial volatility. The dollar doesn't just rise in isolation, it pulls something else down with it. Now let's talk about the uncomfortable math. The US runs massive trade deficits. It imports far more than it exports. That's not a bug, it's how the system stays alive. America sends dollars abroad, the world sends goods back. Those dollars don't disappear. They come back into US assets, treasury bonds, stocks, real estate. That recycling keeps US borrowing cheap and market stable. But when the dollar gets too strong, that loop breaks. Foreign buyers don't need as many dollars to buy US assets. US exports become expensive and uncompetitive. Global demand weakens. And suddenly, America's advantage starts working against itself. Here's the part no one likes to admit: the US doesn't just benefit from a strong dollar, it depends on a managed dollar, strong enough to command trust, weak enough to keep the world functional. That balance is fragile, and history doesn't offer much comfort. In the early 1980s, the dollar surged after aggressive rate hikes. US manufacturing collapsed, exports cratered, allies panicked. The solution wasn't free markets, it was a coordinated intervention to weaken the dollar. Because even then, policymakers understood something uncomfortable: too strong is dangerous. Today, the stakes are much higher. Global debt levels are enormous. Emerging markets are more interconnected. Supply chains are tighter. Financial markets move faster. The dollar sits at the center of all of it. This creates a quiet paradox. Every time the US tightens policy to protect its own economy, it destabilizes others. Every time others destabilize, they rush back into dollars. Every rush strengthens the dollar further. Feedback loop, not malicious, not intentional, but deeply structural. And here's where public hype collides with reality. You'll hear that a strong dollar proves American dominance, that it shows faith in US institutions, that it's a sign the system is working. What you won't hear is that dominance creates dependency, and dependency breeds resentment. Countries don't just accept permanent vulnerability, they adapt. They diversify reserves, they settle trade in alternative currencies, they build parallel systems slowly, imperfectly, quietly. Not because the dollar is failing today, but because the risk is asymmetric. If you're outside the US, a strong dollar is an existential threat. If you're inside it, it's just another headline. That difference matters because the dollar's power isn't enforced by law, it's sustained by participation. And participation weakens when the costs rise faster than the benefits. This doesn't mean the dollar is about to collapse. That narrative is lazy. What it means is something subtler and more dangerous. The stronger the dollar gets, the more it forces the world to seek ways around it. The more it becomes a weapon, even unintentionally. The more it accelerates the search for alternatives, not replacements, pressure valves, and pressure valves, once built, don't disappear. S still holds enormous advantages: scale, liquidity, legal infrastructure, military reach. But those advantages work best when they're not constantly tested. A strong dollar tests them every day. Here's the unresolved question that sits beneath all of this: what happens when the world still trusts the dollar, but no longer wants to depend on it? Because that moment doesn't look like a crash, it looks like a slow erosion. Fewer dollars recycled, more volatility, less margin for error, and in a system built on confidence, margin for error is everything. The dollar's greatest strength may not be how powerful it is, but how carefully that power is restrained. And right now, restraint is not what the system is known for.